This week has been a busy one for both data and news, which means there's a lot to go through. So today we're going to look at what's moved this week, what hasn't, what's just noise, and what actually matters if you're a buyer or a homeowner. And then towards the end, I'll pull it all together with the key takeaways, who this market applies to right now, and who can probably just ignore most of it and sit tight. If you're one of the regulars, as always, thanks for coming back. And if you're new here, welcome along. I'm Craig. I've been a UK mortgage broker for over 25 years, and every Friday that I do a calm, no nonsense update on what's actually happening in the mortgage market. So if that's something that you're interested in, please consider subscribing to the channel because it really does help. Also, just a reminder, this channel is really shaped by what you comment. I do read them, I do use them, and it's often where the best topics come from. So please, if there's something that you want covered, do mention it below. So let's start with the big picture this week. And if I'm being honest, it's been one of those weeks where on the surface it looks a little bit messy, but underneath, the direction is actually quite interesting. We had some slightly worrying signs in mortgage pricing, a few lenders pushing rates up, which always makes people nervous. But, and this is the key thing, it doesn't necessarily mean we're heading back into a sustained upward trend. Because at the same time, we've seen swap rates drop, which I'll come on to in a bit. And that's usually the early indicator that lenders may be able to ease off again in the coming days and weeks. So it's a bit of a mixed week. Rates up in places, but swap rates down, and lender behaviour shifting again, especially around first-time buyers. And that is really the theme of this week. A few short-term pricing bumps, but a bigger positive change is happening underneath. So firstly, let's look at mortgage rates. This week we've seen something that we don't really love seeing, and that is lenders nudging rates upwards again. Now that doesn't mean the market is collapsing, and it doesn't mean rates are suddenly about to take off. But it is a reminder that lenders still price cautiously, and they can react quickly when they feel uncertainty. And the thing is, a lot of borrowers see lenders putting rates up and assume that's because swap rates have surged. But that hasn't really been the story this week, because swap rates have actually dropped, particularly after the Bank of England base rate decision. But we'll talk more about that later. And what that normally suggests is that lenders should have a bit more breathing space to improve pricing again, especially on fixed rates. So what we've had this week has been a little bit of a timing mismatch. Mortgage rates up in the short term, but swap rates moving in a more positive direction. And in practice, what that means is this. We may be in for a brief patch where lenders are adjusting their margins, tweaking pricing, reacting to demand, but the underlying wholesale market is actually giving them room to come back down again. So I wouldn't panic. But I also wouldn't assume that every lender is going to drop rates overnight. This tends to happen in waves. So swap rates dropping is a good sign because they are obviously one of the biggest drivers behind fixed rate mortgage pricing. And when they fall, it usually means lenders can reprice competitively, assuming that is that they want the business. And that's the key phrase here, assuming they want the business. Because lenders don't just price off swap rates, they also price off appetite. So if a lender's pipeline is full, or they've hit their targets, or they just don't want too much risk, they'll hold pricing firm or even increase. If they want market share, they get aggressive. And this week, what we're seeing is that appetite is coming back, but it's targeted. Now, before I move on to lender behaviour, if you want to be kept up to speed with lender rate moves, do go follow me on Instagram where I post daily to my stories about every up and down that is made. So moving on to lender behaviour, and the big story this week is Santander's first time buyer special scheme at 98% loan to value. Now, I want to spend a few minutes on this because on the surface it sounds really headline grabbing, but the details really matter here. So first up, yes, credit where credit's due. Santander are the first mainstream lender to go up of 95%, offering up to 98% loan to value, and that is a big moment. But as always with mortgages, the headline isn't the whole story. So let's dig deeper and see what this actually looks like in the real world. First, the 98% bit. So there's a minimum £10,000 deposit. Now, to be genuinely borrowing at 98%, that £10,000 has to be exactly 2% of the purchase price, and that happens at £500,000. If you're buying anything below that, which most first-time buyers are based upon average prices, your £10,000 deposit could actually push you closer to 95 or 96% loan to value, not 98. So for a lot of buyers, this isn't really a 98% mortgage in practice. And once you're in that 95 to 96% range, suddenly you're back into the territory where other lenders and potentially better priced products come along. And that's the really important nuance that gets missed. Next up is the income, and this is the real gatekeeper here, because Santander capped this at 4.45 times income, So to use the maximum loan, you're looking at an income of over £112,000. So while this is marketed as a deposit helping product, and it is very much a higher income solution. Now that's not a criticism, it's just reality. Also, let's talk about location, and in particular London. There are two big issues here. First, the £500,000 cap. In many parts of London and the southeast, that simply doesn't stretch far enough without a much larger deposit anyway. But secondly, and this is the big bit, flats are excluded. Over half of London's housing stock is flats and maisonettes. So even if the income does stack up, a massive chunk of typical first-time buyer properties are automatically ruled out. That alone means that this product just won't work for many London buyers. And then we've got the eligibility limits that narrow the pool even further. These are first-time buyers only, and both applicants must be first-time buyers. Employed applicants only, no self-employed for now. No flats, no new builds, no Northern Ireland, and no shared ownership at this loan to value. So what Santander have actually done is build a very targeted product for a very specific type of buyer. Employed, higher income, buying a house rather than a flat with a relatively modest deposit. That's fine, but it's not universal. But here's the bit I really want people to think about. Because for some buyers, a small tweak, maybe a slightly cheaper property, a slightly higher deposit, or even just restructuring things slightly differently, could move them from 96% down to 95%, and suddenly the market opens up. More lenders, fewer restrictions, and potentially better rates. So this isn't a case of this is good or bad, it's a case of this is very specific. And as always, the smartest move is understanding where you actually sit, not just chasing the headlines. On a much smaller but still positive note, we did have West Brom Building Society announce that they have reduced stress tests, meaning the average person could borrow up to £28,000 more. That represents a 13% increase based on the average mortgage amount and term for lending above 85% loan to value. Now let's move on to house prices, as this week both Nationwide and Halifax released their latest house price data. And it actually gives a pretty useful snapshot of where the market is heading as we move further into 2026. Firstly, Nationwide, they're reporting that annual house price growth has ticked up slightly to 1% from 0.6% in December. And on a monthly basis, prices were up 0.3% after falling 0.4% the month before. So, nothing dramatic here, but it does suggest that the market is still gently moving in the right direction, rather than slipping backwards. The average house price is now sitting at roughly £270,873, which is basically flat compared to last month. But Nationwide also pointed out that activity dipped towards the end of 2025, and that's probably not surprising because there was a lot of uncertainty around property tax changes ahead of the budget, so some buyers did clearly pause. But interestingly, mortgage approvals remain close to pre-pandemic levels, which tells you demand hasn't disappeared. It's more that people have been hesitant and cautious. And the biggest theme from this report is affordability. Nationwide are basically saying that affordability improved throughout 2025 because earnings have been rising faster than house prices, and mortgage rates have been gradually easing. They gave a really useful benchmark as well. A typical first-time buyer with a 20% deposit is now looking at mortgage payments equivalent to about 32% of take-home pay. That's still slightly above the long-term average of 30%, but importantly, it's well down from the 38% peak we saw in 2023. So affordability is not easy, but it's clearly improving. Regionally, London saw one of the biggest improvements again, mainly because house price growth has been weaker, wages have been rising, and rates have come down. But London is still by far the least affordable part of the UK. And one of the most interesting points in this report is that in London, actual first-time buyer earnings are around 45% higher than the regional average, which really highlights how difficult it is for typical earners to get on the ladder. So overall, this report backs up what we've been seeing. The market isn't booming, but it is stabilising, and affordability is slowly moving in the right direction, which should support activity as we go through 2026. Moving on to Halifax, who have also just released their house price index, and it's actually a pretty interesting one. The headline is this: house prices rose by 0.7% in January, which is a big swing considering we saw a fall of 0.5% in December. And the big milestone, the average UK property price is now just over £300,000. Meaning we've officially broken through that mark for the first time. Now, annual growth is sitting at 1%, up from 0.4% in December, so Halifax are basically saying the market has started 2026 in a steadier position than most people expected. But what I think is most important here is the context. They're pointing out that wage growth has been outpacing house price growth since late 2022, which is quietly improving affordability month by month. And we're also now seeing mortgage deals priced below 4%, which again is helping confidence. Now, Halifax is still realistic. They're saying affordability is a challenge, especially in the south, but their view is that house prices will likely rise somewhere between 1 and 3% this year. And one more key point. The UK is becoming more split regionally. Northern Ireland is up 5.9% annually, Scotland 5.4%, and the strongest parts of England are still in the northwest. But London, the southeast, southwest, and eastern England are all showing annual declines of more than 1%. So, overall, it's not a booming market, but it's a market that's holding up better than most people expected, and it's gradually stabilising. Now, what's interesting is this lines up quite closely with what we've just talked about with Nationwide as well. Nationwide also had annual growth at 1%, but their monthly increase was smaller at 0.3 compared to Halifax at 0.7. And Nationwide's average price is still lower, around 271k, where Halifax have now pushed above 300k. But the message is basically the same from both lenders. Affordability is improving slowly, activity is resilient, as always, and we're seeing a market that's moving forward, just not dramatically. And honestly, that's probably the healthiest kind of housing market that we can have right now. So next up, the big one, yesterday's Bank of England base rate decision. As expected, the bank has held base rate at 3.75%. But here's the important part. The vote was very tight, tighter than everyone expected. It was a 5-4 decision, which means 4 members of the committee actually voted to cut rates immediately down to 3.5%. And when you see a split like that, it's pretty strong signal that we're getting close to the point where rate cuts could start becoming the default view, not the minority view. Now, the reason they've held is fairly straightforward. Inflation is still above target, but it's clearly easing. CPI dropped from 3.8% in September to 3.4% in December, and the bank expects it to fall back further to 2% target around April time. A lot of that is being driven by energy prices and some of the measures from the budget, but the bank is still being cautious because what they really care about is not just inflation falling temporarily, they want confidence that it's going to stay around 2% sustainably. And this is where the disagreement inside the committee comes. The group that voted to hold are basically saying, we can see progress, but we want more evidence that lower inflation feeds through into wage growth and price setting. They're still wary that if they cut too quickly, inflation could stick above target and they'd have to reverse course later. On the other side, the 4 members who voted for a cut are increasingly worried about the economy slowing too much. The bank is openly acknowledging that growth is subdued, demand is weak, and the labour market is loosening. Unemployment is now just over 5%. So those members are essentially saying, look, inflation's coming down, and if we keep rates restrictive for too long, we could end up doing unnecessary damage to growth and employment. Now, for mortgage borrowers, the key takeaway is this. This doesn't mean mortgage rates suddenly drop tomorrow, but it does reinforce the direction of travel. The bank has said very clearly that based on the current evidence, base rate is likely to be reduced further. And that's a big statement. It tells us that the peak is behind us and we're now in a phase where future decisions are about timing, not whether rates actually come down. And importantly, mortgage lenders price off swap rates and market expectations. So in many cases, mortgage pricing moves ahead of the base rate decision anyway. So if we continue to see inflation cool and wage growth ease, there's a very realistic chance that we see mortgage rates gradually improving throughout 2026. Now, if you're buying or remortgaging this year, my advice is still the same. Don't try to perfectly time the bottom of the market, because even if rates fall slightly later, you don't want to lose a property, miss a deadline, or end up on your lender's standard rate while you're waiting for the perfect deal. The smarter move is usually to get prepared early, secure an offer if you can, and stay flexible so that you can benefit if rates improve further. So overall, yesterday was a hold, but the close vote tells you cuts are getting closer. And for borrowers, that's a positive signal going into the rest of 2026. Right, so the big message this week, and honestly, I think this is one of the most positive shifts that we've seen in a long time. First-time buyers are becoming the flavour of the month again, and that is exactly what the market needed. For too long, it's felt like the market has been stumbling along in favour of landlords, or people with big deposits, or people with a lot of equity that has already built up in their property. And that's not a healthy housing market, because if first-time buyers can't move, the whole chain jams up. Home movers can't sell, and downsizers can't downsize. the entire market just slows. So lenders pushing harder for first-time buyers is not just good for first-time buyers. It's good for everybody. And it genuinely feels like the early stages of a much bigger shift. Not overnight, not instantly, but directionally, it's a really positive sign. And going into 2026 and 2027, this could be one of the most important trends we watch. Because if lenders keep competing for first-time buyers, we could see affordability improve, and that tends to bring activity back into the market. So, who should actually act on this? Well, the answer is mainly first-time buyers. If buying is on your radar this year, don't sit back and wait too long. Not because rates are going to explode, but because if lenders keep pushing products at first-time buyers and confidence returns, we could start seeing property prices respond. And that's the bit that people always underestimate. When the market feels more accessible, demand rises. And when demand rises, prices tend to follow. So if you're a first-time buyer, this is the time to start behaving like someone who's going to buy. Get your paperwork in order, know your numbers, get an agreement in principle done properly, and understand your deposit position. Because the buyers who win aren't always the ones with the biggest deposit. They're the ones who are ready. Now for home movers, it's a slightly different story. If you're upsizing or moving, it's still a sensible market, but you don't need to rush because of this week's news. The bigger advantage for home movers is simply being organised early, especially if you've got a chain. As for the rest of you, if you're already in a fixed rate and you're not remortgaging anytime soon, honestly, this week isn't something to lose sleep over. Yes, a few lenders edged pricing up at the start of the week, but swaps dropping is a positive sign. So I'd say it's a watch and monitor week, not a panic week. And if you're remortgaging the next 3 to 6 months, this is where you need to be a bit sharper. Because what catches people out is they assume they'll wait for rates to improve and then lenders move the other way for a couple of weeks. And suddenly the deal they thought they'd get is gone. So if your fixed rate ends this year, the sensible move is to review early. Get something secured, and then if rates improve, you can actually adjust later, dependent upon lender flexibility. Now, just quickly, other political noise this week. A lot of the headlines have been followed up by the political side of things. Keir Starmer trying to survive yet another drama. You know, the usual story and the usual distractions. And honestly, it's not irrelevant, but it's not where the mortgage story is this week. Because markets don't move on those sorts of headlines. They actually move on market expectations. And the mortgage market right now is being driven more by swap rates, lender competition, and confidence creeping back into buyer activity. So my advice is, don't get dragged into all the political noise. Focus on what lenders are actually doing. And what lenders are doing right now is quietly telling us something. Looking ahead into next week, what should we actually watch? Well, there are 3 things really. First, will the lenders start responding to the drop in swap rates? Because if swap rates stay lower, we should start to see pricing softening again. Not across the board, but in pockets. Second, we want to watch whether first-time buyer pricing continues to improve. Because if more lenders join the party, that becomes a proper trend, not just a one-off product headline. And third, keep an eye on confidence indicators. Not just big economic headlines, but what lenders are actually doing behind the scenes. Because lenders tend to move before the public narrative catches up. So next week is less about what's the prediction and more about, are the signs continuing in the right direction? Okay, so pulling all of this together. Number 1, mortgage rates have ticked up in places, which isn't ideal, but it doesn't look like a long-term trend just yet. Number 2, swap rates have dropped, which is a genuinely positive sign and could lead to better mortgage pricing in the coming days and weeks. Number 3, lenders are clearly pushing harder for first-time buyers again, and that could be one of the biggest shifts we see going into 2026. And number 4, ignore the political noise. Most of it isn't moving the mortgage market in any meaningful way this week. Okay, so that's the update for this week. As always, I'll be back next Friday with another calm look at what's happening in the mortgage market and what it actually means in practice. If you want to stay on top of this without getting dragged into the daily headlines, feel free to subscribe. That's exactly what these updates are for. But just remember, this is general market commentary. Mortgage decisions always need advice tailored to your personal circumstances because everybody's situation is different. And finally, if you've got a topic you want me to cover, please drop it in the comments, especially in quieter weeks. That's genuinely how I decide what videos to do next. Thanks for watching, and I'll see you next Friday. Take care.